All right, let's go ahead and get this started. My name's Joe Pivarunas. I'm the founder and managing editor of Nanalyze. We're a boutique media and research firm that researches disruptive technologies for a global audience of institutional and retail investors. So today's presentation is about a company called Coinbase. You're probably already familiar with the company. So we're going to dig right into why we're avoiding the stock. Now, I worked as a manager in some of America's most venerable financial institutions. And one of the strategies that we would take when we were giving people feedback was to always make it a compliment sandwich. So you start out with something positive and you tear them to shreds, and then you finish with something positive. So we're going to start that conversation about Coinbase with something positive, acknowledging a true leader. So the CEO, Brian Armstrong, came out in September of 2020 with a Medium post that talked about how they're a mission focused company and that politics had no place in their workplace. And if anybody didn't like that, he was the package, right? They were given a generous package, and about 5 to 6% of the company's employees left. Good riddance, right? So politics has no place at all in a workplace. Everything should be focused on execution. Take your slogans and your hats and your banners and your petty arguments somewhere else because we're here to work. So props to Coinbase for doing something that every company should be doing. It's actually being talked about as controversial when that should just be the status quo. Politics does not belong in the workplace unless you're Ben and Jerry's. That's where they built their entire business on being political, which is perfectly fine if they want to alienate half their potential customers. So props to Coinbase for doing that. Now, we're going to start this presentation by talking about the importance of figuring out what a company does, how a company makes their money. And a good example of that would be Robinhood. So this is the free trading app you're probably all familiar with. And how Robinhood makes their money is quite interesting. So they love to talk about how they're democratizing access to wealth and all this stuff, but they're doing anything but. So if you look into their financials, and here you can see on the left-hand side, it says assets on their platform. So equities make up a majority of the assets on their platform, right? So you can see 80% of their assets are in equities or stocks, and that generates 32% of revenues. Now, here's where things get really interesting. You can see that options make up 2.5% of their assets, but if you look on the right-hand side, these generate 47% of the company's revenues. So all this talk about how they're opening up the distribution of wealth to the disadvantaged is absolute bullshit. They're actually teaching people by selling them these risky options. They're actually teaching people bad behavior. So we completely disagree with Robinhood, not only as an investment thesis, but also as a company. In the same way that ESG investors take a stance, we would take a stance and say that Robinhood has some fiduciary responsibility to all the newbie investors that jump on their platform to educate them that trading in options is not how you build generational wealth. So if you look even closer, you see that they have cryptocurrency and options. Those two combined risky asset classes, that's where they generate 68% of their revenues from. So it's quite surprising when you dig into a company and figure out how they make their money. So that's what we're going to do today with Coinbase. Now, one of the things we opened up the most recent shareholder letter, we were quite surprised to see how much institutional money has been flowing onto their platform. So here in this chart, this shows you the assets on the platform, whether they're from retail investors or institutional. And as of last quarter, institutional investors now hold double that of retail. So we thought that was a very good thing because they're diversifying outside of just retail. But when you start to dig into the details a bit, that actually isn't where the money's coming from. So transaction revenues for Coinbase don't match the assets on their platform. So even though institutional investors have twice the assets and trading volume of retail, look where all the money's coming from. So just a fraction of transaction revenues are coming from institutional. So all that money flowing on their platform isn't generating the sort of transaction revenue that you would expect. Now, the next question would be, well, what percentage of Coinbase's total revenues come from transactions, right? So we can look at that. Here you can see that of those transaction revenues, 78, or say of total revenues, 78% are related to transaction and 12% non-transaction. So what they're calling subscriptions and services. That number jumps quite a bit. So the next question in this last quarter, that should actually say Q3 2021. So the next question is, did that number jump, that subscription and services, or did the transaction fall and then the ratio changed? So then we can dig a little bit further. Here's the subscription and services revenues that Coinbase is building. So we can see indeed they're growing. That's great to see. They're diversifying their revenue streams. And then we can see that the one that constitutes a majority is called blockchain rewards. Now, that's all about staking, and we'll talk about what that means in a second. And then the second biggest category here, custodial fee revenue, refers to revenues they're receiving for assets being placed on their platform. Now, if assets aren't growing, you wouldn't expect that number to grow either. So the volatility of cryptocurrency certainly comes into play when we're looking at the fortunes of Coinbase. Now, we wanted to talk a little bit about this blockchain rewards category. The way that Bitcoin works, you probably all have a basic familiarity with Bitcoin, is that you have computers that mine Bitcoins by solving problems. It's called proof of work. So in 2009, you could just take a computer in your living room, just with some electricity that you plug in, and you could generate a Bitcoin without hardly any electricity and just a bog standard computer. Well, over time, those calculations become harder to solve as more people are trying to solve them. And to do that same thing today, you'd need an entire room full of high powered computing equipment and about $12,500 worth of electricity to then generate a single Bitcoin. So that proof of work concept, solving equations to generate Bitcoin, is being criticized by quite a few people because it's eating up a lot of electricity. All right. So there's another approach that you can take called proof of stake. And the idea is that if somebody deposits their cryptocurrency into an account and doesn't touch it, that cryptocurrency can then be used to generate more cryptocurrency. And that's about as far as we want to get into the technical explanation behind it. But the idea is that a cryptocurrency can either be mined or this proof of stake concept. Now, the second biggest cryptocurrency, the first biggest is Bitcoin, and the second biggest is Ethereum. Ethereum is actually moving away from mining to proof of stake. That's going to be Ethereum 2.0. That's supposed to come out this year, and it's a big change, and everybody's anticipating what will happen when they make that change. Now, you can see here when Coinbase generates their transaction revenues, 43% of those revenues come from two cryptocurrencies, Bitcoin and Ethereum. So let's say Ethereum 2.0 comes out and just completely blows up and it's an absolute disaster. That stands to impact Coinbase. If Tether blows up and they find out that all the commercial paper that backs Tether is Chinese commercial paper that's worthless, and Bitcoin takes a big hit, that's going to affect Coinbase. So the fact that they're overly reliant on the two biggest cryptocurrencies for transaction revenues is certainly a risk. Now, when the other thing that we need to consider is that as crypto is growing, and we know that money is being poured into cryptocurrency and Web 3.0 and DeFi and all these different concepts, whatever you want to ball that up and describe it as. So Coinbase is appropriately investing in that, and they're investing a lot of money. They're building a business as if that stuff is always going to be growing. You can see here how rapidly their headcount is rising. You can see how much money they're spending. So in 1 year's time, they went from operating expenses of $200 million to $1 billion. So they're spending a lot of money. A third of that is on technology and development. So, just because they're generating a lot of revenue right now and they're able to cover that, doesn't mean if there's a downturn there with their heavy reliance on retail investors, if there's a downturn in transaction revenues, then suddenly they're going to start burning through a lot of serious cash. So that needs to be considered. The revenue streams for this company are very volatile, and that will result in a very volatile stock. Now, one of the things we like about Coinbase is that they're also doing some VC investing. So they've made over 200 investments across the space. So they really are setting themselves up to be a leader by going out there, making investments, learning what other people are doing. So that's the venture investments they're making are quite appealing. Now, the other thing that needs to be considered here is that in the cryptocurrency space, there's certainly some there, right? There is something to blockchain, there is something to cryptocurrency, and there is potential. Now, we're of the belief that at the tail end, presumably, of a massive bull market that's been running for a decade, being in the most risky assets is probably not a good idea. And when you look at this is a fund called Crypto 20, it's meant to give you crypto exposure, and you can see some familiar names in there. But then you see Doge and Shiba. Now, Doge started out as a joke, and Shiba started out as a joke of a joke. So, to argue that either of those quote unquote assets have any intrinsic value, it's an argument that can't be made. So, cryptocurrency in its current form, we believe, is you can spend a little bit of time on Facebook and look at the sort of ads that are thrown up in your face. It's extremely speculative, and it's gone past the mania phase. So when you start to think about diversification, you need to be very careful. Here's a slide that shows diversification effect of Bitcoin and Ether. So the two biggest cryptocurrencies, well, how correlated are they? Do they both move in the same fashion? And you can see that over time, the correlation is quite high. So you're not necessarily getting a diversification effect by holding a basket of cryptocurrencies. They're also reading that recently Bitcoin is starting to become more correlated to the equities markets, and it's actually losing its diversification effect, which is what one of the reasons that we hold some Bitcoin is for that diversification effect. So when you think about diversification in crypto, this needs to be considered in the same way that even if Coinbase manages to diversify outside of just having Bitcoin and Ethereum being their primary trading pairs, that they still stand to have a great deal of risk just based on the fact that crypto market isn't the stock market, and cryptocurrencies are prone to behave in a similar fashion, especially with the herd that quote unquote trades them. So when we look at Coinbase as a potential investment, it's certainly reasonably valued based on our simple valuation ratio, which takes market cap, divides that by annualized revenues, which is the last quarter times 4. Now, we've calculated that ratio over 3 time periods, and you can see how that jumps around quite a bit. So, because their revenue is volatile, the valuation will jump around very quickly, and the stock price is also volatile. So, we wouldn't consider the firm to be overvalued. We certainly find it to be an excellent pick and shovel play on the growth of cryptocurrencies. But at the moment, we're avoiding the stock because we believe that their over reliance on retail transaction fees is a problem. So they're now subject to the fickle whims of the Reddit types, and that's not a good place to be. So we're going to keep an eye on Coinbase. Once they start to further diversify those revenue streams that we looked at earlier, that'll be great. So it's at 12% now. What would it need to get to be appealing? Well, a majority would be nice. So we're going to be keeping an eye on the firm. We think it's a great way to play cryptocurrency as a pick and shovel play, but we don't believe right now is a good time given that over reliance. So thanks so much for your time. Make sure you subscribe to our YouTube channel, and we'll be producing more videos around topics such as cryptocurrency, synthetic biology, and all kinds of disruptive technology. So thank you very much.